The car market isn't slowing down, it's falling off a cliff. Repossessions are exploding, showrooms are empty, dealer lots are overflowing, even brand new cars are turning into financial nightmares. This crash is loud, messy, and hitting wallets across America. If you thought car buying was brutal before, 2025 just flipped the entire game on its head. Let's begin with the visible warning signs. Number 15. Cars are too expensive to afford. Car prices have skyrocketed beyond what most Americans can reasonably pay. Just a decade ago, a $100,000 salary could get you a comfortable home, a reliable car, and still leave room for savings. Today, that same $100,000 barely covers the price of a single luxury vehicle. For example, a new Range Rover Sport SE now starts at $104,600 before taxes and easily hits $113,000 after taxes and fees. That's a staggering 41% price increase since 2016. Yes, it has sleek 23-inch rims, premium seating, and a modern body design, but it's still a depreciating asset with a luxury badge. So what happened? Over time, government mandates piled up. Airbags, crash safety zones, backup cameras, emissions controls, and more. Each regulation added research and production costs. Automakers had no choice but to bake these costs into the final price tag. On top of that, the legal environment became hostile. Huge lawsuits over the Chevy Corvair, Ford Pinto, and Audi 5000 put automakers on the defensive. That meant even more spending on safety, compliance, and legal teams, again, passed on to the buyer. Meanwhile, costs of living have soared, but wages haven't kept up. Food, housing, and insurance rose sharply, eating into disposable income. It's no longer just about affording the car. People now struggle with fuel, service, and insurance premiums. Even entry-level models have crept out of reach. Cars that once cost $20,000 now start at $35,000. Buyers are being priced out, and many are simply walking away. This isn't a normal cycle. It's a visible sign of a system out of balance and one of the clearest warnings that the car market is in deep trouble. But hang tight, because the next money trap doesn't even wait for you to leave the lot. Number 14. Skyrocketing insurance rates. According to the Bureau of Labor Statistics, costs have risen nearly 46% since late 2021, and they're still climbing month after month. Drivers now face $2,000+ annual premiums, even with clean records. If you live in states like Florida or Michigan, you're paying even more, sometimes double that. What's driving the spike? Modern cars are harder and pricier to repair. They're loaded with tech, microchips, cameras, sensors. One fender bender can cost thousands to fix. Mechanic wages are also climbing. Parts shortages haven't gone away either, and insurers pass all those costs back to you. Many buyers now skip coverage research entirely. That's a mistake. That budget SUV could have sky-high premiums. A flashy brand may come with a flashy bill. Before buying, compare rates for your specific model. A less famous insurer might save you big. Insurance is now crushing monthly budgets, right alongside high car payments. It's no longer just about the sticker price. This is a hidden cost sinking the car market. Still with us? Good, because the pain doesn't stop at the bank. Number 13. Interest rates are total deal killers. If you haven't shopped for a car loan lately, brace yourself. The numbers are brutal. Right now, interest rates are the highest they've been in over 2 decades. According to Edmunds, buyers in 2025 are paying an average of 7.4% for new cars and 11.2% for used. That's the steepest climb since 2015, and it's not slowing down. The Federal Reserve has raised rates 7 times in the past year. Even drivers with excellent credit are getting hit. A perfect score no longer guarantees you a good deal. These high rates mean buyers are spending thousands more just to borrow money. That $30,000 car, it could cost you $45,000 by the time you're done paying it off. And it's not just interest. Vehicle prices are still sky high. We're seeing low inventory, leftover union strike effects, and a slow recovery from the chip shortage. So you're paying more, on top of more. Worse, many buyers only realize the impact when it's too late. The loan gets approved, and then the monthly payment hits like a brick. This isn't just a finance issue. It's one of the biggest reasons the car market is stuck and sliding fast. And here's where it gets eerie. What dealers aren't showing you says it all. Number 12. Showrooms are empty, but dealer lots are packed. There's nothing showroom worthy at the moment. Walk into a dealership and you'll notice it right away. The showroom floor feels bare. A few scattered models, maybe one dressed up in a bow. But it's quiet. Too quiet. Now step outside. The dealer lot is overflowing. Cars are packed bumper to bumper. Some lots are so full they're renting space on empty fields and old strip malls just to store overflow inventory. It's not because cars are flying off the shelves. It's because buyers are no longer biting. High prices, high interest rates, and sky-high insurance are keeping people away. Even flashy models aren't moving. Trucks over $60,000 are sitting untouched. Bronco Raptors, F350 Platinums, and top trim SUVs have been waiting for months. Some haven't moved in over 200 days. And here's the real kicker. Dealers don't want to admit it. So they pull cars out of the showroom to make it appear that things are selling. But the truth is, the backlots tell the real story. People aren't lining up for new cars anymore. And the longer they sit, the worse the market gets. That empty showroom? It's not a design choice, it's a warning. And if you've ever wondered where all those untouched new cars end up, click to watch what happens to new cars that never sell. Number 11. Huge discounts, yet still no buyers. The deals are wild, but no one's biting. We're talking $10,000, even $20,000 off MSRP, 0% financing, extended loan terms, cashback offers that sound too good to be true. A few years ago, buyers would have lined up for half these deals. Today, crickets. Even with these offers, the lots are still full. Inventory is piling up week after week. Some cars are sitting unsold for months, even with markdowns. It's not about the discount anymore. It's about trust and math. People remember the dealer markups, the hidden fees, the overpriced add-ons, and they're still recovering from paying pandemic-inflated prices. Add to that higher insurance costs, record high interest rates, and fears about negative equity. It's no surprise buyers are staying away. Some folks are also just plain stuck. They overpaid 2 years ago and still owe more than the car is worth. Trading in now? Not an option. The market is frozen, not because of lack of incentives, but because confidence is gone. When even big discounts can't move the needle, you know something deeper is broken. And that's exactly what we're seeing right now. Now buckle up because the banks are coming and they're taking the keys back. And if this rattled you even a little, hit like and subscribe for breaking updates before the rest of the world catches on. Number 10. Repo rates are skyrocketing. Cars are going back to the banks fast. Repossessions are climbing, and it's not just subprime borrowers this time. People with decent credit, solid jobs, and even two-car households are falling behind. Here's why. Car payments have reached historic highs. Many buyers locked into loans with sky-high interest. Others paid pandemic-inflated prices and are now underwater, owing way more than the car's worth. In fact, repos are up 23% from last year. Tow trucks are busier than ever, and it's not just old beaters. We're seeing recent models, like 2022 Dodge Chargers, Ford Explorers and even Teslas get hauled away. These aren't people skipping out on payments by choice. They simply can't keep up anymore. Repos are one of the strongest indicators of a financial squeeze. When people can't afford to hold on to their cars, the ripple hits the whole market. More repos mean more used inventory. More inventory means faster depreciation, and that just traps even more owners. It's a vicious cycle, and it's picking up speed. But what if you never even get approved to begin with? Let's talk about that. Number 9. Loan denials are at record highs. Right now, 1 in 5 applicants are getting turned down. That's a record high. And it's not just people with bad credit. Even buyers with decent scores are being told no. Why? Because lenders are nervous. Repos are up. Defaults are rising. And banks don't want the risk. So they've tightened requirements, higher credit scores, bigger down payments, shorter loan terms. It's harder than ever to qualify. That means more people are stuck. They want to upgrade, but they can't get approved. So they hold on to their old cars, whether they're reliable or not. It's a silent freeze in the market. And here's the kicker. Many shoppers don't know they'll be denied until it's too late. They find the car, sign the paperwork, and then hit a wall with financing. This isn't just bad for buyers, it's bad for dealers too. Inventory sits unsold. Values drop. The slowdown spreads. Loan denial rates this high haven't been seen in years. And if lending stays tight, the market won't move. Fewer approvals mean fewer sales. And that's a massive red flag. And while you were looking ahead, your old car just nosedived in value. Number 8. Used car values are collapsing. Not long ago, used cars were gold. People were paying more for 2-year-old vehicles than brand new ones. Today, that bubble has burst. In the first 6 months of 2025, some used cars have lost 25% to 35% of their value. That's faster than we've seen since the 2008 crash. The reason is simple. Dealers overpaid at auction, buyers overpaid during the shortage. Now, interest rates are up, demand is down, and inventory is stacking up. The math no longer works. A 2022 Ford Edge that sold for $38,000 last year might only fetch $25,000 today. A used Ram 1500 or Hyundai Santa Fe? Same story. Values are sinking. It's brutal for anyone who financed their vehicle during the peak. They're underwater by thousands. Trade-in offers are shocking, and it's freezing the market. People who want to upgrade can't. People who want to sell are stuck. Dealers are hesitant to buy used inventory because values keep falling. This collapse is happening quietly but quickly. If values keep tanking, the car market promises no point of return. When used cars lose trust as a safe investment, the entire market starts to wobble. And that's exactly what we're seeing now. Shockingly, you're not alone. Millions are sinking fast with no trade-in rope in sight. Number 7. Negative equity is now normal. The average driver owes $7,200 more than their car is worth. In some cases, it's over $10,000. And this isn't just a few unlucky buyers, it's everywhere. How did we get here? Simple. People bought overpriced cars during the pandemic. Add sky-high interest rates, longer loan terms, and fast-falling used car values. And now, the numbers don't add up. You might own a 2021 Jeep Grand Cherokee or a Honda Accord. It looks great, drives fine, but it's worth far less than what you still owe. Now try trading that in. Dealers will either lowball you or flat out reject the deal. It kills your ability to upgrade, refinance, or switch vehicles. And when negative equity becomes normal, the whole market slows down. People can't move. Cars don't sell. New inventory stalls. Everyone's stuck. Even buyers with solid credit are being told they need massive down payments just to cover the gap. Negative equity is no longer rare. It's the reality for millions. And until that debt resets, the auto market can't recover. This isn't just a warning sign. It's the anchor dragging the whole thing down. But if you think it's only buyers underwater, wait until you see who's dumping their fleets next. Number 6. Rental car giants are fire-selling their fleets. Something strange is happening with companies like Hertz and Avis. They're flooding the used market with thousands of barely driven cars and at massive discounts. Why? Because they overbought in 2021 to 2023 when new car supply was tight. Now demand is cooled, rideshare is down, and fleet depreciation is accelerating. So they're dumping inventory to cut losses. That means a tsunami of low-mileage vehicles is undercutting dealers, shrinking resale values, and wrecking used car pricing stability. It's a fire sale, and it's warping the market in real time. The fallout? Resale prices plunge, dealer margins vanish, and trade-in values tank even harder. This isn't a glitch. It's a systemic pressure point cracking from the inside. So, who's really to blame? Number 5. Manufacturers killed affordable cars. Every major automaker is shifting focus away from affordable models. That isn't by accident, it's a strategy. They're leaning into SUVs, EVs, and luxury trims that deliver higher profits, and pushing out the reliable, budget-friendly cars we used to count on. Take the Nissan Versa S, for example. In 2025, it's the only new car in America still priced under $20,000. Even then, that's for the bare-bones manual version. Opting for the automatic bumps the price to around $21,800. And it's rumored to be discontinued by April 20th, 26 due to low demand and rising costs. Chevrolet dropped the Malibu sedan, and the Mitsubishi Mirage is now a past. That leaves even fewer low-cost options on dealer lots. Despite inflation pushing car prices up 34 to 36% since 2019, economy sedans aren't profitable enough under heavier safety and emissions regulations. Without $20,000 and under new car choices, buyers are steered toward $30,000 SUVs or loaded crossovers. That's pricing out middle-class families who rely on affordable commutes and dependable rides. It's no surprise demand is cratering when most people either can't or won't pay that much. The next move wasn't just greedy, it was also strategic and deadly. Number 4. Automakers prioritize profits over practicality. Automakers stopped asking, "What do people need?" and started asking, "How much can we squeeze out of them?" Instead of basic cars for daily life, we now get tech-loaded SUVs with massage seats and 23-inch screens. Great for bragging rights, terrible for bank accounts. Remember when the Toyota Corolla was a no-nonsense commuter? Now it's a hybrid tech showpiece pushing $30,000. Or the Ford Maverick. It launched as a budget truck under $20,000. Fast forward to 2025, good luck finding one under $32,000. And that's for a mid-trim. The Honda Civic? Once a practical go-to for first-time buyers, now pushing $29,000 just to get decent features. Instead of serving everyday drivers, manufacturers packed cars with sensors, screens, and semi-autonomy. Why? Because luxury sells better, but practicality, that got left behind. So now, working-class buyers are priced out. Families are delaying upgrades. First-time car buyers are completely lost. Automakers didn't just raise prices, they raised expectations, then failed to deliver on real needs. This crash didn't come out of nowhere. It was built, one overpriced trim at a time. And now, the market's paying for it, with interest. The damage didn't stop at pricing. What happened next shattered faith entirely. Number 3. Consumer trust is broken. For years, dealerships played games. And now, buyers are walking away. Remember those ridiculous $10,000 markups on basic SUVs? Or being forced to pay for VIN etching, nitrogen tires, and protection packages you never asked for? Yeah, no one forgot. Finance managers pushed overpriced warranties. Admin fees magically appeared on paperwork. And buyers? They got trapped, confused, pressured, and ripped off. It didn't stop at shady pricing. Some dealers even hid interest rates, padded loan terms, and pushed extras just to boost their own bonuses. And during the pandemic, things got worse. Scarcity gave dealers the perfect excuse to jack up prices and kill negotiations altogether. Now, people do their homework. They check forums, reviews, and Reddit horror stories. And guess what? They don't trust anyone anymore. A new car should feel exciting. But today, buyers show up ready for battle, not the showroom. That damage isn't temporary, it sticks, and the word spreads fast. Trust is easy to lose. And right now, the industry's overdraft is massive. If you think that's a coincidence, it's not. Something even bigger is happening behind closed doors. Number 2, automakers are slashing production. Nissan just announced plant closures and job cuts, shutting down 7 plants and eliminating 20,000 jobs globally. In Japan, production is being paused, reportedly to slash global manufacturing capacity by 20% and save $500 billion, aiming to stem annual losses of $4.5 billion. In the US, they're trimming Rogue SUV output by around 13,000 units over the summer. Meanwhile, Stellantis is pausing production in Canada and Mexico, temporarily laying off 900 US workers and halting plants in North America, just after a sharp 20% drop in US vehicle shipments. They've even pulled 2025 guidance due to auto tariff chaos and weak demand. Why does this matter? It's simple logic. Fewer cars built equals fewer cars sold, and less revenue spreads across the board. Dealers, parts suppliers, and even customers hurt when lines go idle. Beyond the headlines, this slowdown signals a tough shift. Automakers are admitting that their strategies aren't working, whether it's soaring costs, tariff headaches, or plunging demand, and they're pulling back fast. These production cuts reveal the root of the crash. Manufacturers aren't just reacting, they're retreating. And when the source of the problem is pulling the plug, the fallout hits hard. And now, even the so-called future is starting to rot on the lot. Number 1, EV hype has collapsed. The electric dream is turning into a dealer's nightmare. Ford's Lightning and the Mach-E, they're just sitting on lots. What once had months-long wait lists now can't find buyers. Even with steep discounts and incentives, they're gathering dust. Tesla is not immune either. Used Teslas are losing value faster than expected. Resale prices are dropping. Demand isn't what it used to be. Some Model 3s have lost over 30% of their value in just 1 year. So, what went wrong? For starters, EVs were pushed way too fast. Buyers weren't ready. Charging networks weren't ready. And let's be honest, many EVs were priced like luxury toys. Even basic models can cost $50,000 or more. That's a tough sell when interest rates are sky high. Then came range anxiety, software bugs, and expensive repairs. Suddenly, the future of driving felt more like a gamble. Automakers bet big, but they bet wrong. They built fleets of EVs without building buyer trust. And now, the market's correcting brutally. Too many EVs, but not enough takers. And a whole lot of money down the drain. The EV bubble is deflating in real time and dragging the market with it. Don't fall for fire sale tricks. Cheap doesn't mean smart. The real bottom hasn't hit yet, but it's coming. Be patient, stay informed, and don't waste money on junk. In our next video, we'll reveal 17 SUVs so reliable you'll never regret buying them.